Okay, welcome back to our debt, bond, and bank session. So our first speaker is Kevin. So Kevin is the Assistant Professor of Finance at the University College Dublin. Before he joined UCD, he was the Assistant Professor of Finance at the Southwestern University of Finance and Economics in China. And before he stepped into academia, he actually worked at the Financial Authority in South Korea. So Kevin's research interest lies in banking, financial intermediation, and corporate finance. So welcome, Kevin, and the floor is yours.
Thank you very much. So let me share my screen. Okay. 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 Thank you very much for inviting me to the symposium and the conference. So my name is Kevin Gam. I'm currently in UCD in Dublin, Ireland. And this paper is joint work with Joey Choi in Louisiana State University and Ho-Jung Shin in the California State University. So in this paper, we talk about how the environmental reputation of the bank itself also can affect the bank's liquidity, especially in the region exposed to severe climate change risk. So the background, the motivation of this paper is the growing importance of the climate-related issue in the banking sector stability. So many countries' financial regulator and policymakers also highlight the importance of the climate issue, even in the banking sectors. However, the empirical evidence for the specific channel between the climate issues and banking sector stability are still underexplored. So that is also one of the important background. Another important motivation and background is this paper also motivated by the growing literature that addresses the stakeholders' role in engaging in the firm's ESG practices. So the many papers already talk about how the customers or mutual fund or lenders discipline the firm's ESG practices. So in our papers, we focus on depositors, one of the bank's key stakeholder, as one possible channel to reach the bank's environmental reputation affect their ordinary businesses in terms of deposit collection and the credit provision. So one of the important curiosity of this paper, this project is all of us actually depositors. So we actually discipline the bank. That is our question. So we try to find some important anecdotal evidence regarding this paper. So that is the Dakota Access Pipeline Project. So that is the DAPL project in the United States in 2016 to 17. So that is the underground oil pipeline construction project in the United States from the North Dakota to Illinois. But this project actually triggered a lot of protest and big issues across the United States because of very serious concern about its impact on the ecosystem and environment, and also important site of the Native Americans. So at the time, also this also affects also banks. Why? Because the banks also provide a lot of funding to this project. So at the time, for example, the Wells Fargo US bank provide a lot of funding to this project. So at the time, according to some news media, many people across the United States say that they plan to close their deposit accounts with the Wells Fargo and US bank, which provide loans to the DAPL project as a part of protest against the DAPL. So this evidence, this is important anecdotal evidence regarding our papers. So in our papers, our research question is, how do a bank's environmental reputation affect their bank's deposit? And also as a result of the deposit withdrawal, how this also affects credit provision in the region exposed to severe climate change risk. So one of the important identifying assumptions is that the people living in the region exposed to severe climate change risk, especially concerned about the bank's environmental reputation. So our finding is the banks with a bad reputation or poor reputation for the environmental issues are more likely to experience a decline in deposit, especially in the region exposed to severe climate change risk. And as a result of that, the banks with a bad reputation for environmental issues also reduce their mortgage origination in the region with severe climate change risk. And as a result of that, such banks with a bad reputation for the environmental issues also cut their liquidity creation if those banks have a high deposit share, that means high exposure to the region exposed to severe climate change risk. So this paper actually suggests that a bank's reputation for the environmental issue also can be an important source underlying the bank's liquidity in terms of deposit collection and also credit provision, especially in the region exposed to severe climate change risk. So our paper related to multiple strands of literature. The first one is about how the stakeholders shaped the firm's ESG policies. So as I talked earlier, many papers already talk about how the customer or supplier or shareholder affect the firm's ESG policies. So actually, our paper also highly related to the Homeland 2018 paper. This paper actually shows some empirical evidence how the DAPL project affect the bank's deposit. In our paper, actually, we generalize those findings, not just the DAPL project. So we try to find generally, actually, the bank's depositor respond to the firm or banks, the environmental reputation, especially in the region exposed to severe climate change risk. And also our paper highly related to the financial consequence of the climate change risk. Actually, we follow the method of Painter 2020 JFP paper. So in this paper, Painter find that the municipal bond prices are also affected by the climate change risk, especially if the local government is located in the region exposed to severe climate change risk. And we also use the same method to the bank deposit. And next one is also what drives the severe deposit outflow from the bank. So there are so many papers about that. So some papers talk about some fundamental based bank run, and the other one talk about some the panic-based running. For example, Diamond DB model talk about the panic-based running. But in our paper, we talk about our paper story is a little bit different from the fundamental running or panic running. So even the reputation for the environmental issues also can trigger deposit withdrawal from the bank. So that is a difference from the existing papers regarding deposit outflow. And also, we also talk about credit provision issue. So as a result of deposit outflow, we also talk about how the credit provision is affected. So our paper also contributes to the paper regarding the effect of bank's liquidity shock on the lending activity. So move on to empirical design of this paper. So our paper in our data is a branch and year level panel data set. So the branch level deposit is outcome variable. And also we have two important independent variable. So one is MREP risk. So this one, actually this measures the bank's environmental reputation. So how to measure that? We just use the data from the REP risk. So I will talk about that in next slide. And the other one, important independent variable, severe climate change risk, severe climate risk, that is dummy variable that identify the county that have a severe or exposed to severe climate change risk. So I will talk about that in next slide about how to select the region exposed to severe climate change risk. So REP risk, we use the REP risk database to identify each bank's reputation risk for environmental issues. So REP risk measure and quantify each firm's reputation risk regarding all ESG issues, not just environmental issue, but also social and governance issues together. So REP risk cover more than 120,000 companies as of 2015. And the REP risk actually monitor 28 ESG related issues through the media or social media and other online resources in different languages, and just measure and quantify the reputation risk. And our paper, we only focus on the environmental related issues. So that is one of our measure. And the other one is the region exposed to severe climate change risk. So in our cases, the sea level rise is the event regarding the severe climate change risk. So we use the method used by the Painter 2020 JFE paper. So in that paper, a city's climate change risk is measured by the expected mean annual losses from the 40 centimeter rise of sea level and scaled by the GDP. So this expected losses is high enough, then we just assume that that region is exposed to severe climate change, especially this is sea level rise risk. So those cities and counties, the region exposed to severe climate change risk used in our paper. So where is that? So in the map, those dark shaded area, dark blue area is the region exposed to severe climate change risk, and the light blue area, actually the region not exposed to severe climate change risk, especially sea level rise. So sea level rise is actually the event in our cases. So the one issue is that all the region exposed to severe climate change risk, actually all coastal area. And many of the regions without such risk are mostly inland area. So maybe there should be some fundamental differences between the two types of region, and that also may drive results. So because of that, we limit sample to the states in the United States that include at least one county that is exposed to severe climate change risk. But even in the cases, the region exposed to severe climate change risk, mostly the metropolitan area, and many of the region without any such risk are the rural area. So between the two also, there should be some many differences, and that also drive the deposit outflow, differences in deposit outflow. So in last stage, we limit sample to the MSA, the Metropolitan Statistical Area, that include at least one county exposed to severe climate change risk. So we use 3 different samples altogether. So this is the most restrictive sample. So this is the summary statistics. So the branch deposit is one of our outcome variable. And then we also used mortgages and liquidity creation. Those are also important outcome variable. And MREP risk and severe climate risk is our key independent variable. And then we also add the bank level and also county level control variable. So this is the first set of our regression results. So for the deposit, the branch level deposit, in the first column, we use the full sample, and second column, we limit sample to the state with climate risk, and third column, we limit sample to the metropolitan statistical area with the climate risk. So no matter which one is used, the result is quite consistent. And also here, we add the branch fixed effect that actually capture the time invariant branch level characteristics. And also we add the bank state year fixed effect, so that capture time varying the bank level or state level characteristics. So for example, so banks, their own strategy, or banks, their own risk, that also affect the branch level deposit, but that kind of issues are all captured or absorbed by those set of fixed effects. So this result means that if the banks have bad reputation for the environment issues, the bank is more likely to face a reduction of the branch deposit, especially in the region exposed to severe climate change risk. So here, important assumption is that the people, the depositor who live in the region exposed to severe climate change risk are especially sensitive or care about the bank's environmental reputation. So that kind of sensitivity also may change over time, not time invariant. So we also try to decompose the sample into the 2 different periods. There was a period with relatively high and low sensitivity by the residents to the environmental issues. So first one is the crisis or not. So we can conjecture that during the crisis, people and the residents may be more concerned about the financial stability issue, banking sector stability. But after the crisis, people more and more concerned about the bank's environmental reputation. So we just decompose crisis and post-crisis. And also the other one is if the region exposed to or region faces some natural disaster nearby, if there's some natural disaster nearby the counties within the same state, the people may be more concerned about environmental issues of the bank. So we also identify when a certain county faces the natural disaster nearby within the same state. And also we just make the dummy variable. And finally, we just interact with our key independent variable. So this is the result. So we can see that both the triple interaction terms are negative and also significant. So this means the result is more significant after the crisis, and also when there is some natural disaster nearby the county within the same state. And the people's sensitivity to the environmental issues also may different, maybe different across the state, across the region. So there should be some cross-sectional variation about that. So we also try to measure that. The first one is the number of banks in the county, in the local region. So if the number of banks is more, then people maybe more easily reallocate their money across a different bank. They can move their money more easily. So we just account number of banks in each county and scaled by population, and then we convert it into the quartile variable. And the second one is social capital. So in these days, so many papers already document that the social capital is highly associated with the civic norm or the local altruism in the community. This also affects the people's behavior. So we also obtain the data set regarding social capital and then convert it into the quartile variable. And finally, the demographic also may affect people's behavior. So maybe younger people may be more sensitive to the environmental issues or climate change issues, and maybe more flexible to move their money from across a different bank. So we also calculate the fraction of the younger generation in the state, and then we just also convert this variable into the quartile variable. And finally, we interact with our key independent variable. And then this is the result, the triple interaction term, or negative and also significant. So this means the result is more stronger if the number of banks is more and social capital is higher, and also younger population fraction is higher. So this is also interesting and important result. And next one is move on to some spillover effects. So the previous results show that deposit actually reduced more in the region exposed to severe climate change risk if the bank's environmental reputation is bad. So if the bank faces a reduction of deposit, this also may affect the bank's lending. So usually, so deposit reduction is kind of liquidity shock in the branch level. Then the branch may just ask to, one easy way is just ask the headquarters or another branches to reallocate their money from that branches to my branches, but that not always helpful because other branches also have their own loan demand and project. Then it's hard to reallocate the money. Then the branch have to cut their lending or restructure their lending. So we just try to test this prediction. So using by the mortgage origination data. So here, the results show that if the bank's environmental reputation is bad, the bank is more likely to cut their mortgage origination, especially in the region exposed to severe climate change risk. So actually this result, we actually don't know exactly this is driven by the bank supply effect or demand effect. So we just move further into decomposing into the two different types of lending. One is a securitized mortgage and the other retained mortgage. So we can see that the securitized mortgage also decreasing, but compared to total mortgages, the significant is much smaller. The retained mortgages is much bigger. So the result is driven by the retained mortgage rather than the securitized mortgage. That means those reduction of mortgages more likely driven by liquidity shock and driven by supply reduction rather than demand shock. But actually we revise this paper right now. So actually we also try another kind of variable such as approval rate. Actually approval rate also reduced in this regression, and also application itself also reduced. So both supply effect and demand effect actually drive the result. So we cannot actually rule out the possibility that the people also move away from the bank because of the environmental issues. So both kind of demand and supply effect can also explain this result.
Hey, sorry, Kevin. You have
Yeah.
1 minute to conclude, please.
Okay. So I have many other tests, but I cannot cover entire things because time limit. So I just go to just conclusion. So actually in this paper, we suggest that a bank's reputation for the environmental issues also can be an important source underlying the bank's liquidity in terms of deposit collection and lending, and also liquidity creation, especially in the region exposed to severe climate change risk. So we suggest one piece of empirical evidence for the possible channel between climate issue and banking sector stability. Okay, that's it. Thank you.
Awesome. Thank you, Kevin. And so Shabana is your discussant, and I'll share her discussant slides here. Okay.
Hi, Kevin. Thank you very much for sharing this very good paper on the banking sector, especially when there is a very scarce literature on the banking sector regarding this climate risk. So summarizing the paper, I think I will just quickly say the paper just checked the impact of the bank's environmental reputation on banks' deposits, lending, liquidity creation, and management to hedge that risk by relocation of the branches and under those high-risk areas or regions. So you have moderated it with the severe climate change risks. And you have used a very comprehensive data sets from different sources because you have already incorporated very 3 or 4 the main banking operational financial indicators like deposits, lendings, liquidity creation, and branch relocation. Definitely you need some different sources to incorporate. And the time frame that you have looked in is from 2008 to 2015. And the findings are really very interesting, like the banks with a poor reputation on environmental issues has really have a negative impact on the local deposits, and ultimately there is a reduction in the lending, and they have a problem with the liquidity creation, and then the banks do manage it by relocating their branch networks. So I really feel this paper is very strong in the sense like it provides the addition to the literature where we are looking up for some good papers to see how the banks have been impacted with the climate change risk. So this paper is a very good contribution towards that literature. And especially not only from the bank's perspective, I can really see from the depositors' point of view where the depositors are trying to manage their banks through their by withdrawing their deposits, because deposits is the key plays a key role in the banking operations. If there is a lot of withdrawals from the deposits, then ultimately it's there is a linkage between the lending and liquidity creation, and then the bank's own internal management that really affects. So we from this paper we can really see those results that like when there are reduction in the deposits due to that environmental reputation of the banks in the high climate risk areas, then there will be definitely a punishment for the bank, like they will not be able to create the mortgages, or they will not be able to create liquidity in those regions. So this is, I really think this creating this connection or looking at those points is really good contribution by this paper. Sorry. So regarding this paper, I have further suggestions about because you have just checked the bank's environmental reputation is related in the regions with a severe climate change risks. So is there any correlation between the climate change risk region and the environmental reputation of the banks? Because it seems like the climate change risk is the moderating factor that enhances the effect of the banks that are having a bad reputation, environmental reputation in that region, or because you have only accounted for the high sea level as a climate change risk. So there are other factors as well that can contribute towards the climate change risks, like in my opinion, the droughts and in other counties, like they are the major risk as well. So that means the counties that are more prone to the drought conditions, they may have the more environmental reputation related effects as well. So it will be good to see the other factors as well, and how is there any correlation between the two, because it really enhances the effects or not. So secondly, there is, I would love to see how this papers where you can really add up somehow, this can contribute to the towards the central banks as a supervisory role, because now we can see if there is a reduction in the deposits and the banks are relocating their branches from that regions. So the central banks should have have an eye on those banks while they are relocating the branches from that regions. So it will be good to see any thoughts about that in your paper. Yeah, thank you so much.
Hey, Kevin, would you like to respond to any of the comments from Shabana?
Thank you very much for a great comment. And regarding the first comment, so actually my assumption of this, the regression empirical setting is, if the people living in the region exposed to severe climate change, in this case is higher sea level rise, then the people is maybe more concerned about environmental issues. But other papers also have a little different setting. For example, the Homeland 2018 paper that only focused on the DAPL project, then that paper only focused on the distance. So if the people living in the near the DAPL project pipeline, then those people is more concerned about environmental issues, especially in DAPL project. So actually there's many different methods, but in our cases, so the first identification is if the people living in the near the region exposed to severe climate change risk and more concerned about environment issues. And as a next step, I also try to make some variation based on, for example, during the crisis or post-crisis, or especially when the result is more stronger if the natural disaster hit somewhere near the county or social capital. So those kind of things also may affect the people's mind regarding or concern about the bank's environmental issues. But I also need to think more about how more clearly identify that. And also second one, supervisory issue, also a very important, great suggestion. So in our current paper right now is bank itself also try to manage that risk. So if the bank have more exposure to environmental issues or more exposure to the climate change issues, then the bank is more likely to reallocate their branches across the region. At the same time, try to alleviate their environmental reputational risk. So yeah, that kind of thing also can be or maybe reflected on supervisory and regulatory perspective, but also I need to think more about that. Anyway, thank you very much for your comment.
Awesome. Thank you, Kevin. We actually have one question from the floor. It's from David Tribe from Massey University.
Yep. Kevin, I'm sorry we didn't get to see what you've done in the robustness tests, but there were a few issues concerned me as we went through. First thing I noticed was the very high R-squared stats. and that made me a bit uncomfortable, but I actually think there may be some issues with your explanatory variables being correlated with each other and not necessarily having the right set of explanatory variables. Now, for example, I noticed you looked at some measures in relation to local competition. Now, there's a more extensive, there's a reasonable local competition literature in relation to the US banking market, which looks at the impact of community banks and the national banks. There's the obvious point about the younger customers. Yes, they may be more environmentally sensitive, but there's also the issue that younger customers have less investment in the relationship they have with the bank and are therefore more inclined to change banks in any case. So I think that by the time you get to some of your interaction variables multiplying a whole lot of things together, I'm wondering whether we're actually starting to measure some other effects. What I actually wonder, and you may have done this in the robustness tests, is that if you run all your other explanatory variables first and then drop in the environmental reputation at the end, see how much difference it actually makes to the results. But you also need to look for correlations between those explanatory variables.
Oh yeah. Okay, so thank you very much for your suggestion. Yeah, I need to check about correlation across the different explanatory variable. So in our robust checks, some of the robust checks about regarding the competition issue, I already add some Herfindahl index, HHI index for each country level in the as a control variable, and actually also our fixed effect only compare two different branches within the same bank at the same time in the same state in the same year. So many of the variation within the bank, across the bank or across a different region can be absorbed by fixed effect. But actually we need more and more robust tests for now because some of the variables actually can be correlated each other, and that also can drive a result. So I will actually buy your point, and I will also try to update the result more after that. Thank you very much.
Awesome. Thank you, Kevin.